You don't want to miss this episode. We're going to talk about the hidden tax on your wealth, inflation, why you're falling behind, and how to beat it. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me as always, Christina Wyatt. How you doing today, Christina?
Hey, Darren, I'm doing great. How are you doing today?
I am fantastic. I'm excited for this inflation podcast. It is just drives me nuts. This inflation and how it erodes people's wealth and hurts so many sectors of the economy that people don't realize, and it's always bugged me. So I've wanted to do a podcast on this for a while.
Yeah, it's one of those things that flies under the radar. People, you hear it talking, inflation this, inflation that, Bank of Canada rates, but people really need to get into it and understand it to see how it's really taxing us, right? How it's impacting our wealth building.
Yeah. Okay. So let's talk about inflation a bit. So most Canadians think the biggest tax they pay is income tax, and don't get me wrong, it's a huge bill in Canada. But there's another one you don't get the tax bill for called inflation. So there's no CRA tax slip in the mail, but it's just basically reducing your purchasing power. Okay, every single year your dollar gets less and less valuable, and people think they understand inflation, but it's again not just prices going up. People get that, but it's your money losing value, and so you got multiple factors decreasing what you can actually buy, and it's a really big deal. I'm excited to chat about today.
Yeah. Now, before we jump in, I do want to remind everybody if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review for us. And if you're listening or watching on YouTube, please make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok. We've got lots of new content coming out regularly. You're not going to want to miss it. So let's jump into this. I know you kind of give a bit of an overview there, Darren, but I want to dig into the basics. So let's start. What is inflation really? What is it?
Yeah, I mean, simple definition is it's too much money chasing too few goods. You know, if we lived in a fixed world where there was only 100 homes and everybody was making $100 and we doubled everybody's wages to $200, well, those homes would probably roughly double in value. So the more money you have chasing too few goods, prices go up. So when governments overspend, how they solve their overspending problem is they print or borrow money. So when they print money, they basically take every dollar you've already made and they make it worth less. So it's like a hidden tax nobody can see. The government wants inflation because they want to pay back the big, massive debt we have with cheaper dollars in the future. So the government taxes you directly, they take your money, but when they inflate you, where they inflate the money in circulation, they take your purchasing power. And there's a sneaky part of this too. Who gets the money first? So if you think of money is going to continue to be worth less and less, you would want to spend the money quicker before it devalues. Well, when the government gets money, prints money, they get it first and they spend it when it's still worth more than it will be by the time it funnels down to the rest of us. So it's a win for the government, but it's really just a silent wealth transfer. So people buying assets, we're going to get into in a minute. It's like a silent wealth transfer for people with assets and governments, but it's basically just absolutely penalizing every other Canadian out there.
Yeah, when you look at it from the big picture side of things, right? In the full and how it's impacting. So I want to just take a minute to talk about how inflation gets hidden, because I do feel like you said it's a silent wealth transfer. It gets hidden. How does that happen? The news is always saying that inflation is going up. 2-3%, not much. It seems small, right? But you go to the grocery store and you get there and you get your bill and it's doubled. That doesn't feel like a 2 to 3% increase. Or you get your rent come in and it's jumped 30% in the last few years. Like those are not 2 to 3% increases. And the reason we see those bigger increases at the store and we hear about this 2 to 3% on the news is because that the government measures inflation with the CPI, Consumer Price Index. So you hear about that too, the CPI. The CPI is around 2 to 3%. And what that is a synthetic basket of goods they choose and they can keep changing. They have full control over this basket of goods, right? So they like to use little tricks and adjustments, owners equivalent to rent to make inflation feel smaller than it actually is. For an example, probably a few years ago, they might have said that they're going to use a 1,000 square foot apartment building for the measure. Well, now with efficiencies and things like that, we're making smaller. We've got tiny homes, all that stuff. Well, we don't need to use 1,000 anymore. Let's just use a 700 square foot home instead. Okay, well, that's going to change things in the basket, right? What if steak goes up and they say, okay, well, we're taking steak out of the basket. We're going to put chicken in the basket. It's a little bit cheaper. That's going to throw things off a bit. We can keep this. When you can change things, you can keep things in a 2 to 3% range when you're picking what's going in that basket, right? And that's what they're using. But when you think of it, if real estate prices are skyrocketing, or you go to a concert and that ticket jumps from $200 to 2,000, and I'll tell you, I have a real life example. Last year, I went to a Taylor Swift concert. I would say the first concert I ever went to cost less than $100, and that one was in the $1,000 range to get a ticket. And any Swifties out there definitely felt the inflation on a concert ticket when they went to go see that show. It was much more than a 2 to 3% increase on that concert ticket, but that concert ticket's not going in that basket. Right? It's they've got Netflix subscriptions and they say there's no inflation in there. So they're not adding the things that we're actually doing as consumers when we're looking at that basket.
Yeah. If you're not substituting your steak for your chicken, well, the CPI doesn't mean anything for you. So, who cares?
And Darren, we didn't even talk about housing, right? Where does housing fit into that CPI basket? Because I can tell you, most people have felt their house costs skyrocket by much more than 2 to 3% in the last couple of years. So where does housing fit in the CPI?
Yeah. The price of a home is not included in CPI. So CPI has a housing component, and it's going to be it's going to be a sort of a split of rent versus and half rent, or not half, but part rent, part interest charges on your mortgage, but no principal payments. So if you're paying much more in the principal payment because the houses are costing more, it really doesn't get reflected in the CPI. So again, it's like, oh, inflation's 2 or 3%, but it's like, how come young people can't afford homes anymore? Because housing prices have skyrocketed. So CPI is not if you're in the home for, if you're what you want to buy is a home, well, your inflation might be 15 or 20% over the last few years versus the 2 or 3%. So if you're getting 2 or 3% raises, well, great. If you're just buying what's in that basket, maybe you'll be okay. But if your goal is to buy a home or buy an asset, then you're not even coming close to keeping with pace with inflation. So it's a real kind of, I don't want to say sneaky, but it's a misleading indicator of individuals. It's overall consumer spending, but what if I don't want to substitute chicken for steak? Or what if I want to buy a home for the first time? What if I want to buy a Taylor Swift ticket? Whatever you want to buy, that's your inflation. So your inflation is a much different number than CPI.
Yeah, exactly. And another thing is that that's just one type of inflation, right? There's actually two types of inflation that we need to be paying attention to. And I think most people focus on this one, but I think we should dig into the two different types.
Right. So everything we've kind of talked about, the CPI and all that, that's consumer inflation, right? Groceries, gas, utilities, everyday living costs. But there's also, that's not included in there, asset inflation. So again, if you wanted to buy real estate, housing, investment properties, or even if the stock market. So if, the stock market has gone up 10% a year for the last 10 years, well, you want to now get into the stock market for the first time. Well, It's not been 2 or 3% increase in inflation, so now that basket of goods you wanna buy includes the S&P 500. Well, that's up over 100%, 150% in the last 10 years. So, your basket of good doesn't, or the consumer price index does not include assets, and assets is really what builds wealth, right? So if you want to get wealthy, you need to buy assets. So most people are focused on this consumer price index, but it's asset inflation that quietly kind of determines who gets wealthy and who falls behind. People buying assets are getting wealthy, or people that have assets are getting wealthy, but it's terrible for those people that haven't got to the assets level yet.
Yeah, when they talk about the rich get richer, this is one way why it happens. And I think the central banks say that they're trying to help, but they're actually making it worse.
Yeah, oh, absolutely. So if the central banks are targeting 2% inflation and they try to keep your wage growth, so that's basically they're trying to keep wage growth around 2% when they say that. Um, but if assets go up 5% and your pay or groceries go up 5% and your paycheck raises 2%, okay, you're losing a little ground there. But if assets, housing, Bitcoin, stock market, real estate, if that's rising way faster, that's not even counted in the CPI. So when the headlines are like inflation's under control, no, it's not. Not if you want to buy a home, not if you want to buy assets. So that kind of second level of inflation on the increased in the assets, it's really why the wealth gap keeps widening. So why are the rich getting richer? Because the government's printing too much money. It's causing assets to rise very rapidly. Assets are going up in value. The people that own assets are getting wealthier.
Yeah, and if you look at the last couple years, they were pretty much a perfect storm. Right? Goods and energy costs spiked, wages lagged, house prices exploded. It's probably the worst combination we've seen for an everyday Canadian, but the best possible one for people that already owned assets, right? All those assets went up, wages went down. It was literally the perfect storm over the last few years.
Yeah. So if we jump into sort of how do we fix this problem, it's almost an unfixable problem when you look at the housing market. So you've got a couple choices here. Can the government do something to drastically reduce the price of housing? Well, what would happen then? You've got someone that bought a $500,000 house and has a $450,000 mortgage. Well, if that house is worth 300,000 now, that person's bankrupt. That's, thousands of Canadians are bankrupt overnight. So the government's not going to do something that decreases the price of housing because it's going to bankrupt so many Canadians. But if housing prices keep going up because they keep printing more money, and again, the other problem we've had in Canada is we've had so many new people come into Canada. Now we've got more people chasing fewer homes, so that's driving up the price. So it's really an unfixable problem. They can't drive down the price of housing, and they keep printing more money. It's just increasing the price of housing, but the wages are going by this CPI number, so the wages aren't keeping pace. So you get this gap just going. Housing must go up, and if wages are staying relatively around the CPI, they're not keeping pace with the price. So the gap of the wealthy and the poor just widen. So it's not good news.
All right, Darren. So with all of that information on this, and I know some of it's pretty negative here, but what's the real lesson? What's the takeaway from this?
Yeah. So I think that the takeaway from this is inflation isn't one number. It's like two worlds. We've got consumer inflation, the spender. Okay. It hurts the spender. If consumer inflation's going up, it hurts the spender. But when asset inflation is going up, okay, now it hurts the non-owner of assets. So if assets are going up and you're a non-owner of assets, you're falling further and further behind. So the real game isn't fighting inflation, it's getting on the right side of it. So if you want to beat inflation, okay, you're not going to do it by cutting out your lattes. Like, that might help a little bit, but the real key is you need to get into the owning assets part of the game. where you control your own capital, because we're going to have inflation. Assets will continue to go up. Governments will continue to print money. So you need to flip which side of the script you're on. Instead of being just a consumer and spending everything you have, you need to get to a point where you're an owner of assets, and that's the way you're gonna tackle inflation.
Yeah, so let's get into the good stuff. How we can solve the problem. How can we tackle inflation? How do we use infinite banking to do that? Let's chat about a solution for everybody. We talked a lot of downers, Darren. Let's
Yeah.
talk about how we can fix it.
We've got solutions, right? So, we talked about, well, you want to own assets. You don't want all your money just going to spending on consumer goods. So to actually build wealth, there's a system around that's been around for hundreds of years, and there's really four things you need to do. Okay? So if you want to beat inflation, you want to get ahead of it, there's four things you need to do. Step number 1 is your savings must keep pace with inflation. Okay. So we've got people, you get savings and investment. Well, savings, a lot of people are still saving in cash or bonds or something. You're earning 1 or 2%, but then you're paying tax on that. You're netting 1 or 2 or half a point or 1. So your savings got to keep pace with inflation. Well, infinite banking solves that problem, because your savings, the cash component of your cash value life insurance policy, we've got a death benefit and the cash value. Your cash value long term is going to grow somewhere around that 5 to 6% amount, but it's going to grow tax free. Okay, so we've got tax free growth of 5 or 6%. That means your savings is keeping pace or outpacing what inflation is. So step number 1, get your savings into a tax-free vehicle like cash value life insurance, grow it long term. That's going to be step 1, your savings. Now, step 2 is you must reduce taxes. Taxes are getting higher and higher and higher. Income tax is brutal in Canada, and guess what? It's going to be more brutal long term. Look at the government debt. The government will have to increase taxes long term. So what do most people do? Most people are putting money into RRSPs. What is that doing? It is deferring your tax liability. RRSPs are not a tax deduction, they're a tax deferral. So you're deferring your tax liability, where your RRSPs are going to keep growing and you think you have all this money, but now you're going to be putting yourself often in a higher tax bracket because as your RSP grows, and then you go to take that money out in 10, 20, 30, 40 years. Well, now you're going to be in a much higher tax bracket because chances are your RSPs grew. But number 2, income taxes will increase in Canada because of a massive government spending and debt. So you're deferring this to a future higher tax liability in many cases. So again, the solution, cash value life insurance, infinite banking concept, you flip the script and you say, great, I'm going to put my money in a vehicle that grows tax free. I can access tax free via tax free loans. I can retire tax free, where I can leverage that money in retirement and spend that 100, 200 grand a year, 300 grand a year, whatever you borrow against it each year, tax free in retirement. So we're not only managing the savings, we're managing the income tax, and income tax is not going to get better. It's going to get worse. And if you are going to be hopefully wealthier long term, your marginal tax bracket will probably increase. So the more you can do to plan now for your retirement in a lower tax or tax-free scenario, that's how you get ahead of inflation. It's you say, great, we're going to manage our savings, step 1. Step 2, we're going to manage our income tax. And then we're going to jump into step 3 is the next step, Christina, which is really, I think, the secret sauce.
Yeah. So before we jump into that, though, I just want for my business owners listening out there, when you think about those tax savings, it's crucial. As business owners, we get hit with 3 to 4 layers of tax, right? We get taxed on any growth when we're investing in our corporations. We get taxed when we want to take the money out and spend it in retirement, right? If we need to get money out of that corporation, we're absolutely paying tax on it. And then we get taxed when we die, right? So even more layers of tax than an individual for a business owner. So it is very important that if we want to stay ahead of inflation, if we want to become wealthy, we get a handle on that tax. And the infinite banking, the high cash value corporate life insurance really shines here, right? Because we don't have any tax on the growth. Grows 100% tax. It's essentially a TFSA for your corporation. We don't have tax when we spend it. We take those policy loans. We have lending strategies we can use in retirement. We don't get taxed when we die, which is huge from an estate planning side of things, that we can flow that death benefit out using the capital dividend account. It's amazing the difference. Like, I can compare these types of policies to other investments in corporations earning very high returns, and these policies will come out better. Nothing to do with the rate of return in them. We're keeping up with inflation, right? We got 5 to 6% tax free, but if you can eliminate 3 layers of tax, you're way ahead of the game. So for business owners, very important to get a handle on that tax. So I wanted to drive that one home. Tax side.
No, great point, Christina. Thanks for that. So, okay, so let's jump into step three. So, what's the secret sauce? What is step three? How do you combat, beat inflation, and prosper in today's economy?
So number 3 is you must buy assets. This is how wealth is built. So you're never going to get very wealthy just saving, right? At the end of the day, savings will keep you stable, absolutely, and we want to save and we want those savings to keep up with inflation, but it's the assets that's really going to make you rich. It's going to make you wealthy, right? So investing in real estate. Well, we always say, some of the best things you can invest in are your business, and real estate. You need to do that. Like, real estate is going to make you wealthy. Businesses, private lending, Bitcoin, you name it. Like, your investments and your assets, which are generating those returns for you, are what really are going to beat the inflation. And infinite banking works so well, and the high cash value works so well, because I always tell people, yeah, if we save in this policy, we're absolutely going to keep up with inflation, right? We're good to go. You really want to kick inflation's butt. What we're going to do is we're going to utilize what we call the and asset, and we're going to borrow against the policy, and we're going to put it into an asset. And that asset's going to make you, I don't know, if you get 10, 15%, we're laughing, right? Because inflation's already covered in our savings account. And now we're building those assets on the outside while our savings are still compounding inside of our policy. So the problem is most people never actually have access to cash available. And when the opportunity knocks and they have that big investment opportunity, their money's locked up. It's in RSPs, it's in pensions, it's in a volatile market. They don't want to pull out in a down market. But if you have this high cash value life insurance policy sitting there, saving, earning, that keeping up with inflation, you have access at all times. You have full control, right? No questions asked. You take a policy loan, you put it into that opportunity, you borrow against it, money's still growing inside, and now we're multiplying, right? We've got our money working in more than one place at one time, and we're building our assets. So the goal isn't just, and when I'm talking to people, the high cash value life insurance policy is great, but the reason we spend so much time on the education piece is this: if you utilize it right, you can become very wealthy.
Love it, love it. It's like double compounding. You grow it inside the policy, and you grow it in the asset you buy when you leverage those tax-free loans, and you get this tax-free death benefit. Okay, so that's step three. Now, if we jump into step four, okay, so you must protect your wealth from, especially in retirement, from market downturns. So let's say you did everything right. You bought assets, you bought the stock market, you bought real estate, whatever it is, those assets you buy, and now you retire and you go, oh great, now I'm going to take an income from these assets. I'm going to start, cashing out some of these assets every year. I'm going to spend, whatever my retirement goals are. And then all of a sudden we have a big massive market correction. So, picture 2001, 2008, 2020, stock market drops 30%. Well, where people get absolutely devastated in is, well, you still want to sleep indoors and eat in a down market. So if you start selling those assets when they're down 30, 40%, there's no recovery for you. You will not recover from that scenario. So you've got to have an uncorrelated asset, which again is cash value life insurance, which will never go down in value. So we've done podcasts on the volatility buffer, but generally speaking, let's say you've got $1 million of stuff in the stock market, and you're spending 50 or $100,000 a year in the stock market, and the stock market drops 30%. The last thing you want to do is cash out some of that stock market when it's down. You want to not touch that and allow it to come back before you access it again. So again, having that uncorrelated asset of cash value life insurance gives you the opportunity to say, great, this year I'm not going to sell any of my stock market stuff or other asset that plummeted, real estate, for instance. I am going to borrow from my cash value life insurance, tax-free loan, and I will live off that this year in retirement. And I will wait until that other asset I own, stock market or real estate or Bitcoin, went back up to, what it was worth or even more, then I will access money from that asset. So if you do this, it not only just protects you in your retirement, but it literally allows you to spend almost double what you would normally otherwise spend because you have this built-in volatility buffer that says, I'm not going to be affected by volatility like 99% of the people that are affected in retirement. And I got to tell you, I've seen retirees just petrified to spend money because what if there's a market correction? What if everything goes down? What if I run out of money? Having this uncorrelated, guaranteed to go up every year, guaranteed never to go down cash value life insurance just gives you this peace in retirement going, nah, things are going to be okay for me. I know I can handle that. So it's the one strategy that really in retirement is going to allow you to live comfortably, spend more money, and not stress. So you'll probably live longer because you won't be stressed in retirement. So to kind of recap the 4 steps, if you want to win the game of money, right? We all want to win the game of money. You must make your savings keep pace with inflation. Check infinite banking. Reduce or eliminate taxes. Check with infinite banking. Buy assets, and that's that opportunity fund Christina talked about. Great, we get that with infinite banking. And you must protect those assets from a downturn. So infinite banking accomplishes all 4. And there's actually a bonus 5th one we can get into. So Christina, why don't you tell the listeners, okay, we're going to do all these 4 with infinite banking, but what's our bonus 5th step that we can do with this product?
Well, on top of all this, we can also create generational wealth because with this policy, there's also a large tax-free death benefit that's going to pass down wealth to the next generation. Cash value life insurance is the most tax efficient way to pass down wealth to the next generation. Bypasses probate, 100% tax free. So we're going to eliminate that tax problem for them, and they're not going to start at zero. So for a lot of individuals, we start at the bottom, we work our way up. But imagine if you could start in that extra step. Your parents or you set your children up for success, and they had that extra step on that compound growth curve. Well, that's exactly what we can do for the next generation. We can make sure that they start with capital so that they can buy their assets sooner. We can set them up with their own policies so we can create generational wealth, not just first generation, second, third, fourth. Like this can go on forever if we want it to, and we set it up correctly. But we're going to allow those next generations to buy the assets, have the capital, get their own policies in place, start their own snowballs of compounding uninterrupted, just like what the Rockefellers did. So we talk about the Rockefeller method in Canada here a lot on our podcast. We've been going through it. And it's not just about the high cash value life insurance piece. It's a financial system. This is a blueprint for wealth. It's a family bank that we can pass on from generation to generation. It doesn't just have to stop here.
I love that, Christina, because just picture if you were 25 years old and all of a sudden you had an extra $1 or $2 of tax-free money to start buying assets then, as opposed to like most people getting in their late 20s, 30s, 40s, before 50 sometimes, before they really start buying significant assets. So this generational wealth with infinite banking and the Rockefeller method is literally snowballs. Kids, grandkids, everyone's going to benefit from this. And picture how much your life would be different if you had all kinds of tax-free money when you were young to buy assets. And I love this. So, all right, Christina, great podcast. I love this one. So if you want to beat inflation, escape taxes, buy assets, survive downturns, and create generational wealth, infinite banking is going to check all those boxes. If you want to learn more, please come to Control and Compound for a complimentary education session with one of our wealth coaches. We're happy to walk through how it will work exactly in your situation. Thanks for watching. Thanks for listening. Have a great day. Thanks for watching that episode. Don't forget to subscribe to our YouTube channel. Click that like button, hit that bell button so you never miss an episode. And if you want to learn more about us, go to controlandcompound.com. We'll see you next time.
Thank you for tuning into this episode. The information contained in this podcast is for informational and entertainment purposes only and is separate and apart from the wealth coach services provided by Darren Mitchell and Associates, Inc. to its qualified clients. Control and Compound Financial expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, or any other damages arising out of any individual's use of this podcast or the information in it. The views expressed here are those of each participant and guest and not necessarily those of or endorsed by Control and Compound Financial, its affiliates, subsidiaries, and their respective directors, shareholders, officers, or employees. For full disclosure, visit controlandcompound.com/podcast-media.